Good morning, everyone. My name is Josip Kosic, and welcome to Options Trading Live. Today's quarterly expiry, Friday, June 17th. I'd like to confirm the sound. If you can type in the chat box that you hear me, that would be wonderful. It would be appreciated. So, we are not financial advisors. Please take a moment to read the disclaimer, even if you need to pause it. Let me show you a place where you can get in touch with me. Here's the address, josip@tradewithufos.com. Also, after each session, we post the notes on our website. This is our website, tradingwithunfilledorders.com. And after the session is over, I on that website, tradingwithufos.com/Josip, post my notes down here. So as you can see, there was a session that I did about 10 days ago. There was a session that I did back in May 24th. So when I'm done with the session, I will post the notes right there. And we are going to start now by looking at what the current situation with the market is. So just to one more time repeat the whole thing. This is where you can find the notes, what the market is doing right now. Dow has rallied up, and since then it has pulled back. Same thing with NASDAQ, came down, filled the gap. This dot represents the open. But when we pull up our website here, trading with the ufos.com, we have a platform that is called TOP, Trade Option Planner, that stands for TOP. We notice that on SPY, we have a green UFOs right in this area. So what has happened over the several sessions, if I start reading it from the left to the right, you will notice this is a 9-day exponential moving average, and we've been down for quite a bit of time here. And also in terms of the implied volatility on the puts, it's way higher than implied volatility of the calls. The calls are demarked here by the blue line. Puts are here marked with the gray line. Also, there was an increase in the interest rate, which makes the dollar much stronger. So the fact that price action is coming all the way down to the green UFOs, meaning there's a high chance that it's going to revert back to the mean. And it's very important for you to understand the time frame that you're looking at. So right here, I'm looking at the daily, but in a moment, I'm going to switch here and pull up the monthly chart and do the usual evaluation of what the market is doing on the monthly chart. So good morning, Mark. Good morning, Joe. Good morning, Jeff. Good morning. I'm glad to see you that you're all here. I'm going to go to the big picture, and then I'm going to tell you what we're going to do next. So starting with the Dow Jones Industrial Average on a monthly, this blue line originally represented the trend from the low of the March 26th of the 2020. And when I connected here, January, February, March, this line held for 2 months in February and March. But then in April, it closed right at it. On May, it went below it. It attempted to go above it, and then it failed. So what I'm doing right now with this February 24th line, I'm actually copying it and pointing it out to you that there's a May 20th low that has been significantly broken, and we are now trading way lower. Where do you think we're going to go on the Dow Jones Industrial Average? Well, there's a high chance that we might actually come down at one point and retest these particular lows in this area right here. So when you look at here, we're really not that far from it, but that doesn't mean everything needs to happen at once. So Dow Jones still has a potential to go lower before it finds some decent support. Having looked at the Dow, I'm going to move on to the S&P, because the S&P doesn't look that different than the Dow. The difference is that the Dow has a 30 stocks, S&P has a 500. So again, we have a blue line starting here from March 26th of the 2020, which was the low of the COVID. And then the Feds got involved and the market started going higher, higher, higher. It took out the high, and ever since then we've been on a bull run. January, we had the pullback. February 24th, we created the low. It was defended on a March, and then this blue trend line to the upside was broken in April. In May, we came back above it, tested this from the belly side up, and then we had broken it. So again, I'm removing this February 24th line, and I'm placing it right here on the May 20th low, and currently we are below it. Another thing that I want to point out to you is, where can we possibly go? Well, there's a lot of talk about going to 350. So when you're looking right here, this would be that level of the 350 on S&P 500, which would be 3,500 on S&P cash. So just be aware of it. This is a target that all the major institutions, hedge funds, are predicting that we might go. Why do we expect over there to be a little bit of a speed bump or a slowdown? Because for 4 consecutive months, we've been dancing in that area, and it's only on the 4th month that we broke above it. So I would not be surprised if over there, once when the price comes to that support, we actually have a move to the upside. So having looked at the Dow, having looked at the S&P, I would like to now move to the Russell next. So once again, the Russell always looks a little bit different, because Russell represents not the large companies, but the small companies, like a small capitalization company. And again, starting from the March 26th of the 2000 low, all the way to over here, which was the February 24th low, you will notice that Russell, unlike all other products, have been going sideways for very, very long period of time. In fact, when you look at here, majority of the year 2020, we've been just going sideways. But once when this particular line was broken, this line that I was talking about, February 24th, a lot of things have changed. A lot of things have changed for better. No, a lot of things have actually changed for worse. So when you're looking here, this February 24th line could simply be moved down here to the May 20th, which is a low that is more recent. And of course, currently we are trading below, but we don't know where the month is going to close. So could it be that the IWM rallies up? Well, in comparison with the other ones, the piercing of that May 20th is not as sharp and as steep as it is on a Dow and as it is on a S&P 500. So that's a significant observation for us to know when we are trading something, especially considering maybe going bullish, because there's going to be a lot of buying opportunities at one point in time. The next point that we need to make is, where do we think most likely we're going to slow down? So again, this would be that same area I was pointing out to you earlier, that for about 3 or 4 months, the price action was struggling to break through the upside. And of course, when we come down to that area, there's a high chance that there might be a slowdown. And coincidentally, that would be around 150 on IWM or on a Russell ETF. So 350 would be on a SPY, or 3,500 on S&P cash, and a 150 would be on a Russell. So as of now, I'm going to keep this on the back of my mind, because in the moment I'm going to be discussing the possible strategies, and we always have 3 possible strategies, which is a bearish, bullish, and a neutral. So I'm going to just bring up here my agenda. So after I'm done here with the big picture, I'm going to be entertaining the bearish scenario. And bearish scenario can simply be a bear call spread, which involves buying the higher unit and then selling the lower unit. So that would be the one possibility. And then we'll talk about a neutral trade. And bullish trades. But before we talk about any of this, we need to revisit the technology sector. And the technology sector is tracked by the NASDAQ ETF that tracks that. It's actually QQQ, so it includes 100 technology stocks. So following the consistency, I'm talking about March 26th of the 2020. That's a COVID reversal to the low of the February 24th, which again got pierced in March. And over here, when you look at it, February 24th was touched in March. It bounced hard. It actually created the higher high than the February, and then everything was erased. In April, we closed significantly below it, and then in May we went even lower. And then when a rally came up, it touched that trend line, what I like to say, from the belly side, and it was unable to break through it. So that low of the May 20th is right here. And when you look at right here, this is June, and we have pierced through it. But what is interesting, we haven't pierced as much as we have pierced on these other products, such as Dow Jones Industrial Average. So Dow Jones Industrial Average has pierced this more than either the Russell or the Nasdaq, which means that we need to actually do a little bit of more in-depth analysis of what is taking place. So when I was talking about here these months in the early 2020, it's important to notice that when the market took off, after the Feds have got involved, it rallied significantly. Now look at QQQ. We have already pierced through those levels, and we are now at the bottom part of this area, which is kind of interesting because one can even make an argument that there's a high chance that this particular area might hold. So this area right here where we are might actually hold. So at that case, what can we do? Well, we can actually start looking at the daily by using the Bollinger Bands. And the Bollinger Bands are something that a lot of people are talking about it when it comes to the reversal to the mean. So one of the ways to do this is simply to insert the study. So it's important that we keep in mind that we are on a daily. We click here where it says add a study, and we have right here Bollinger Bands, and I don't like to alter any of these things. I just like to keep it the way it is. So on a daily, it looks at the 20-day simple moving average, and then it looks at the 2 standard deviation. The upper band is going to be in the green, the lower band is going to be in the red, and the 20-day simple moving average is going to be colored in blue. So when I apply this and click OK, obviously we are below the 20-day simple moving average, and we are now outside of the Bollinger Bands. Now, there are a few things historically that we can pick up by looking at this thing, is that when a price action goes outside of the Bollinger Bands, then there's this rubber band effect or the snap back in it, which means at this point, should we be doing the bear call spreads when we are this low? Well, that's the question that anybody who's trading needs to ask themselves. So if I compare this to, let's say, to the SPY and see how the SPY is looking in this particular case, it's hugging this Bollinger Bands and it's going lower and lower. That doesn't necessarily mean it's going to snap back, because historically over here, we're doing the same thing, pushing the bands, pushing the bands, pushing the bands, and then the price start closing outside of the Bollinger Bands. And it was at that point that the price action snapped back in. So let's compare it against the IWM. And the IWM doesn't look as steep in terms of the drop. And in fact, the price action is already showing the possibility of going up. Having presented all this big picture, the question becomes, what are we going to do with that information? So one of the things that we can do with that information is simply that we go back to our options with options set up on a SPY and notice where is the nearest UFO on a daily. The nearest UFO on a daily is right at this level, which is significant, which is again that's 3,500 on a S&P or the 3,500 on a SPY, and this is where possibly we are going to see um, a bounce. So going back to one more thing that I started introducing in my session last time, and that is a second patented device that we have on our platform, which is very easy to insert. We just go add study, and there's two of them that are patented. And the first one I already talked about, which is automated UFOs. So as you're looking right here, that's the patent. And we have an option volume patent right here. So I'm going to insert the option volume, and I'm going to look at what is happening on today's expiry in terms of the activity. So when I pull it up here, I will not be changing anything. I'm going to be using the 3 monthly strike prices, and I will be actually focusing on June more than on the July or August. So when I line this up like this and I bring it up, I want to point out several things in terms of the activity here. We obviously have a blue line that represents the calls, and we have a red line that represents the puts. And the put buying has been quite significantly more than call buying. Now, what I think that is very important here, not to get bullish before we actually have that movement to the upside, till we have this hook to the upside. And what I mean by the hook to the upside, I mean the price would need to do exactly what is S&P doing here on these 10-minute bars. It's supposed to count down, break the downtrend, and then start going up. Now, as you can see on these 10-minute bars, we can see that hook is already happening, that we are going into the positive territory, which means that area is being defended by the buyers and there's a purchasing taking place. Now, on the daily, that hasn't happened yet. That simply it hasn't happened yet. So what can we do with that whole situation? Well, we can actually decide whether we want to be bearish, neutral, or bullish. So what I'm planning to actually introduce to you right now is the concept of the bear call spread, with the mindset that in case I'm wrong, I can turn it into a bullish spread, and in case I'm right, I'm gonna then basically stay in the bear call spread the way it is. So just to kind of build this piece by piece, I want to explain that the bear call spread is built by the 2 units. But before we can sell anything, we need to buy to open the higher unit. And once when we bought to open the higher unit, we can then proceed to the selling to open lower unit. Now, keep in mind, if the market rips and it goes higher, what is the one thing that I can do in order to neutralize this effect of me being wrong? Well, simply I can be adding to this higher units more. And the reason why I'm saying adding to this higher units more is that in that case, I'm going to have a type of ratio. And what do I mean by that? Well, I'm still going to be short one lower unit, but I will have a 2 of the higher units. Now, having said that, why don't I just go ahead and fire the trade in? Now, before I fire the trade in, I want to make sure that I do go back to the whole concept of utilizing these activities that are taking place. And again, one of the ways to figure out what is really taking place, for instance, this number 365 is a call that has been traded quite a bit. And when I look at this particular option in terms of the price, this 365 has a price of basically $2. So keep in mind, I will be now considering buying the 365 and having it at the money. having it at the money. Okay, so let me now spell out here. So if I'm buying here at the money 365, and of course I can then be selling the lower one, right, which is a 364, and currently the SPY is sitting here at 364 and some change, let's say 60 cents, 90 cents, doesn't matter. So it would be clear in that case that I'm trading the out of money and out of the money. In case the market keeps on going higher and higher and higher, and as you can see, the bears are not doing a good job pushing the market lower. They did push the Dow Jones at the beginning of my session almost 200 points lower, but right now Dow Jones is neutral, Nasdaq is going out, and also S&P is going out. So in case I place this bear call spread, would you agree that if the price goes up, that I'm already dead wrong? So at that point, you need to ask yourself, what can you do? Well, you can buy another unit of the 365 that is at the money, but as the price goes up, it's going to become even more in the money. Okay. Now, why do I want to call this neutral? Because yesterday we have had the situation, the market rallied, it fooled everybody, and then it tanked. So at this point, if we go down, we are long two of these units, and from here we are only short one of them. Could I, at that point, if you go down, that I go ahead and I sell another of these 364? Yes, I could. So I'm keeping my gunpowder die ready to adjust this. And I'll come back to this bullish part in a moment, but I just want to make sure that what I'm presenting to you actually makes absolute sense. So one more time, what I'm doing here, I'm getting myself into a bear call spread with the intent to fix it because I'm going to be wrong. And how did I arrive at this conclusion? I arrived at this conclusion that I'm seeing a lot of activity here on this expiry right now. So I'm going to be trading this with intention of maybe fixing it and closing it within the next 37 minutes that we have. So having said that, I'm going to just explain to you one more time. Bear call spread is a bearish bet. Okay, the short-term bias is to the downside. Okay, it doesn't require necessarily a rapid drop. So if we are right now at 365.51 and I go ahead and I do that 364, 365 bear call spread, it really just needs to move the $1.50. Okay, so let me now reduce this to the least amount. I'm right here on this side, and you would see this particular bear call spread would already be what? In the money. So let me now do this purposely wrong. Okay, so I'm selling one vertical. Okay, 164, 165, and that is 62 cents credit. That's mean the most I can lose on it is what? 38 cents. Now I'm sending this, and this trade, the way how it is not getting filled. So I'm going to just look it over here and see my working order and see why I'm not getting filled here. Let me just close this so it's not on the way here. So right now they wanna give me 57 cents. If any of you are why am I looking at the June 17? Because these are the most active ones that I can present it in the next half an hour, and I want to show how I can fix it and repair some of it. Okay, so I'm doing this with the mindset to actually teach this live in this last hour. Okay, so I'm waiting for this to get filled. They're not giving it to me. I'm dropping it down to 60 cents. So now when I drop to 60 cents, be aware that this is a $1 spread, right? 365 minus 364 is $1. If I get the profit of the 60, I have a loss of the 40. So I'm now sending this in, and they're still not giving it to me. So that's mean this is high implied volatility. It's really pumped up through the roof. It's pumped up through the roof. They can quote whatever they want, but they are not giving me 60 cents. Could I drop it to 57? Well, I'll drop it, but that's going to be the last thing I'm going to give them, 57. Take it or leave it. I'm going to take it. Okay, they gave me 59. So again, let me now explain what has happened. This bear call spread was actually no longer at the money. It was in the money on the both end. Would you all agree that right now I'm dead wrong on this bear call spread? What would need to happen for me to be profitable by the end of today, or in my opinion, within a half an hour? Okay, the SPY would need to drop below 364 to be winner. Okay, so if you're good with that, please type in the chat that you understand what I'm talking about. I'm purposely entering the trade that is wrong in order so I can teach how do we now repair this thing. Okay, so that's my goal. Because a previous session we show you entry, but then we didn't talk about anything when something went wrong. So in this case, I want to actually talk about this when something goes wrong. Well, just like the pilots during the Second World War when they were fighting on the Pacific theater, they had a statement, don't get frightened during the dogfight with the enemy. You can get frightened later. But when you're looking at the trading is some kind of a combat. If you're wrong, don't get paralyzed by being wrong. You got to do something about it. So imagine we have entered this when the price was at 365.60, and currently the price is most likely higher, 365.95. Would you all agree that at this point I'm dead wrong? So I can now get paralyzed here and do nothing as this price is ripping. Or I can say, okay, I have this market generated information that I know I'm wrong. And what I'm going to do right now, just to show you here, that my position is actually 1 on this one, right? So I have a position here, 1, and I'm going to now go ahead and buy one more contract. So I'm now buying one more contract of the 365 on which I'm wrong. So now when I fire this trade in, when I'm firing this trade in, I'm going to just switch this to the positions so you would see what I have here. Just 1 second, like I need to make sure that I switch this to the position. So you would see now I have 2 of these and I only have 1 of the other ones. So just 1 second. So what do I do now? So now that I have this thing, be aware of it, that exactly scenario that I was mentioning to you could happen. Could the price now turn down lower? Yes or no? And I'm going to take a moment to ask you that question. Imagine you completely switch the sides from the bearishness to bullishness, and then you get fooled just like yesterday, and market now drops. Market now drops. What would you do then? Well, you still have a structure of the bear call spread. That means you have 2 long calls and only 1 sold call. Can you then go ahead and sell another call? Because just in case the price action start again going down, then everybody who went long has been fooled because the price is no longer going where? Up. Because in that case, you really need to ask yourself, what is taking place? Well, what is taking place that we have here high, and in this case over here, I'm going to move the mouse to point out to you that we have here a lower high. So if I have a lower high right here, then what kind of trend do I have? Downtrend. So the next move can be down, and if the next move is down, then how do I then repair my position? In my case, the repairing of that position can be done in such a way that I just go ahead and against this 2 bought 365 and only 1 sold 364, I sell another one. I sell another one. So to make this a little bit less confusing, what I'm going to do, I'm going to start actually using some of these numbers. So you would actually follow what I'm talking about. So originally, when we place this trade on, the lower unit, was trading at the price of the $3. We were able to get the $3.03 of the credit. Okay? The higher unit that we paid for was trading for $2.44. But as you notice, the price have ripped to 366. So if the price have ripped to 366, which is additional 40 cents higher from where originally it was, that's mean I was wrong about 40 cents on it. Well, that 40 cents with the delta of 50 has increased this premium from 244 to the value, if you look at right here, of the 260. So the next unit that I bought is for 260. So if I now feel that I'm completely wrong and market is now going down, I have turned my bearish bias into neutral just for a few moments. And then as the market start going up, I'm trying to make myself neutral. I'm now buying more of this. And now that market is going down, I have ability to sell 364. Do you think the selling of the 364 is going to be still at the 303, or is it going to be at the higher? Take a moment to think about it. It is going to be at the higher level. It's at the 323. So now if I want to turn this by selling, so if we sell, now we're selling for 323. So do you see this thing is still priced quite similar? But if the price keeps on going higher and higher and higher, okay, so take a look. As of now, we still don't have a certainty if we're going to take out this high. We still don't have a certainty that we're going to take out this high, because if you take out this high simultaneously on all three of them, then guess what? There's a possibility in that case that market is going to go where? Even higher. So if the market goes higher on all of them, now I'm going to talk to you about the phase 3. And what do I mean by the phase 3? Phase 3, I mean, is what do we do then? What do we do then? And this is a moment, that I want you to think about it, because I know the answer to the question I'm asking, but I would like to ask the attendees to actually think outside of the box and to say, what would I do in that case? Just like the pilots during the Second World War, do not get paralyzed by fear. Fear is a sickness. When you're fighting a battle for your life, and I purposely have picked this option expert today, that market is moving now violently, so you can lead this, you can learn this in real time. You need to know what you need to look at. Joe, perfect answer. Know your delta. You got to know your delta, because if you don't know your delta, you're completely messed up. Initially, would you agree that when I placed my bearish bet, that I had a negative delta, that my delta was negative? By me adding this one more contract here and turning this into two contracts and only one negative, I neutralize my delta. So rather than now guessing if it's this or is that, why don't I just show you what that delta is? And where can I show you that? Well, I can just simply go right here and show you on my account statement here, on my option, that my delta is, just 1 second here, let me just get this, P&L, okay, delta. Delta right now is a 50, okay? But it's not 50 negative, it's actually what? 50 positive, okay? Well, it's not positive enough, but the fact that it was a negative before, it actually points this out, okay? So let me just now show this to you. If I just go ahead and close this, which I shouldn't do, but if I close it, that delta would become a negative. Right now, having a delta at 50, it's really you flipping the coin, not being certain which way this thing is going to go. So you can look at this as much as you want, and you can say, well, I see the activity. These are the current contract volumes that's been entered. The bar is becoming more green. If it changes to the smaller time frame, we're going to see how all this thing looks. None of this information helps you. What really helps you is looking at the three markets simultaneously, because not everything is in one chart. And this is what a lot of traders forget. Once when they start trading the SPY, they maximize the SPYs of the 1 minute, and that's their universe. That's like somebody who bought the car and is completely in love with that car, and he doesn't know any other car, and then he start noticing, how come everybody's driving a similar car that I have? Well, that's the focus that you have, right? So be aware of it, that if this thing needs fixing, it needs fixing only when a price action takes out what? These highs. So as of now, I can't make these things move. I cannot make these things move. But what I can do is explain in depth that my bear call spread makes perfect sense. And why do I say that my bear call spread makes perfect sense? Going into the long weekend, and please take a moment and think about it. Do you want to be bullish when you have no idea what is going to happen? The fact that in the middle of the day, during the lunchtime, the market had a little pop to the upside, it means nothing in a larger picture. Could it be by the end of the day that we still go down to 364? Could it be? Yes or no? And I'm going to take a moment and a sip of water here. There's a number of you here who have ability to chat with me. Please type in. And what would happen then, if that really happens? What would happen there? I would be kicking myself for buying on the last day one more long call at 260. That's exactly what would be happening. And then I would be questioning myself, what in the right mind was I thinking? Because on a bigger picture, and I emphasize bigger picture, and let me just go here and open up the default setting that Hussein and I love to use, and that's options with option setup. That in a downtrend, I actually went long. And I went long, and if I switch this on a daily, before it even came to the green UFO, we were like, what was I thinking? Well, you were forcing the trade on an option expiry, which is not normal expiry. We only have a 4 quarterly expiry, and they're called quadruple witching because you have a index options expiring, future option expiring, commodity option expiring, and then the regular stop option expiring. And market maker at any given time can zigzag this any way you want. So I want to show you how you actually need to be patient and trade calmly and confidently and patiently, just like these World War II veterans who were sharing their experience during the dogfight that was taking place, let's say in the Midway or Guadalcanal or any of these Pacific theaters. Be afraid later. Do not be afraid during the fight. During the fight, keep your head screwed properly. You have a bear call spread. And what is a bear call spread? It's a bearish bet. Implies that the trend needs to be what? Down. Do we have a downtrend here? I mean, look at it. You have all the information over here. Josip, could you have done this with the puts? Honestly, I had this lesson built for a bear puts. But then when you look at the implied volatility is high, when should you be doing the debits? You should be doing debits when Implied volatility is low. But now that implied volatility is high, instead of doing the bear puts, I switched to do the bear calls and to explain that. So in a single line, what is a bear call? Bear call is nothing else but buying the higher strike price and selling the what? Lower strike price, which is exactly what we did. We went ahead and we actually sold, and let me make this a little bit more obvious for you. We sold 364 one time and we bought two of the 365. Now look at it. My 365 is already overcoming my loss on the other one. Because remember, I have placed this trade. There's a two of them, right? On average price of the 252, and now this is sitting at 270. So you're like, well, then why don't you just close this one? I will close this one, and that's why I keep saying to you, I will switch the sides to the bullish when a time comes. When a time comes, I will switch that. But that time hasn't come yet. When do you know the time is going to come? When all three of them align. And does it look to you right now they're aligning to the upside? I mean, look, S&P is up 0.1%. That's not even 1%. Could this at any given time turn out to be, like I predicted, down move? Could it happen? Yes or no? Take a moment to think about it. You don't need to side with me. You can be on the other side, try to shoot a hole to my thinking. Say, like, no, I completely disagree. This is bullish. It has to go up. We're going in a long weekend. There's going to be peace in the world, and everything's going to be fine. Nelson Mandela is going to get released from prison, and all this. Those things have already happened. We're living in a different environment. At any given time, we can go lower. And if we go lower, what can I do? I can get even better premium by selling the 364 for what? For more money. But I need to have a conviction that that's taking place. And where do I get the conviction? By looking at three things. Not with two eyes, but with three eyes. So how do you feel about the Dow Jones? Dow Jones was up, and now it's already what? Down. It didn't create the higher high, it created the higher low. NASDAQ is the strongest, but I don't worry about NASDAQ. I don't trade NASDAQ. I'm trading the SPY. And over here we have a S&P struggling. Now be aware of it. This is kind of tricky time for me to teach this because we are during the lunch hour. So I want to see what is going to happen over the next 15 minutes. I was expecting a little bit more activity. If this keeps going off, then my lesson plan is completely blown. Because my lesson plan was based on two possibilities. And one possibility was that there's a high chance that the market is going to go where? Down. And in that case, if the market is going down, what is the one thing that I'm going to do? So if the SPY drops and we have two long calls and only one short 364 call, what do we do? Then sell another 364 call with the expectation that we're going to drop where? Below 364, which is very, very possible. Okay, that's the scenario one. Scenario two. If the SPY rallies with all other majors, okay? So maybe I can show you in this case what do I mean by that. Well, in this case, what I mean that the price would go up. So it would just go straight up to the upside like this. Then what will we do? If that's the case, then we need to do something because today is the expiry. Could it be that the bulls got the 1 day break? And that's why I'm in a 1 day option to teach you this. If that's the case, then what do? Switch from bear call into a bull call. And how would we do that? Well, first of all, we would need to close 364 call. And I want to emphasize this, for a loss. Okay? Now, would that loss be significant? No. Why it wouldn't be significant? Because I have two of these that are working for me. Think about it. If we are right now trading at 367 and I'm long two of the 365 calls. 365 calls. How much are they in the money? How much are they in the money? They're in the money by $2, which means I'm up $4. Well, Josip, I don't follow this. Okay, let's go over here. My maximum loss on this is what? $3. We are now at the 367, assuming we're now at 367 and bell is about to ring. My 365 call, this is mathematical fact. This is not opinion. So Mark, Jeff, Joe, do you understand? We're talking about mathematical fact. Today's the expiry, today's the trade that I took. Price is at 367 at the 1 minute before the bell. You have a long 365 call. Without a doubt, that's $2 in the money. And how many contracts you have? 4. Yeah, you got killed on one. Yeah, well, you know what? You went with your squadron to fight in the Pacific against the invading force, and you lost one of your wingmen. $3.03 is lost. $4 is gained. Are you still up? Yeah, that was a battle. That was a battle. So we're still up 97 cents. That's $97 that has enough to pay for everything. Okay? It has enough to pay for everything. But that doesn't mean that it's going to happen. That is just one scenario. My gut feeling, if somebody's asking right now, what do you think is going to happen? I would say most likely we're going to go down, because the way how this acts, it does not inspire confidence. There it is, ladies and gentlemen. This thing is going where? Down. So then you might say, like, well, at which point you're going to then go short and add another one? Well, I like to call this trading the edges. You know what I mean by trading the edges? Trading the edges would be, I'm going to do the activity when these are taken out. And I'm using the red line. Does anybody know why I'm using the red line? Because previously I was using the green line. So I'm not trading the meat of the market. Meat of the market is iron condor. This is not iron condor environment right now with what I'm trying to do. Yeah, perfect, Mark. I would be selling another 364 call, but I would need to be certain at that time that this price is going down. Because could there be another scenario? And I hate to use so many possibilities because people then get a headache. Bing bong, could that happen? And then we chop for the rest of the day. Could that happen? So just be aware of it. When all three of them align, then you need to do something. But right now, there's nothing to do. In fact, what I have here, I have prepared the notes to talk about the disposition effect. Because, I mean, there's nothing for me to do right now till we either take out these lows or we take out these highs. So what is the disposition effect? Well, there's a study out there that is called behavioral science. And behavioral science is basically trading psychology. So when I was preparing for this class, I said to myself, I need to explain this to the attendees and to the traders. So there's this disposition effect that it sounds kind of odd. And a lot of traders have experienced it, and that's holding on to the losers too long while selling the winners too early. So I'm gonna rephrase this one more time. Holding the losers too long and selling the winners too early. What this has to do with us? Well, in this case, you might be feeling the pressure because time is ticking and you need to do something. But wait a second, there's no activity to be done here. There's absolutely no activity to be done here. There's only activity to be done when we either go where? Up or it go down. So majority of your money is made when you are thinking clearly, when you're not acting emotionally, when you're looking at this thing and saying like, okay, so I have gone through the big picture, I have followed exactly what is going on all of these things, and I know we're trading what? Sideways. So if you're trading sideways, then what is the worst possible thing that can happen to you? Worst possible thing that can happen to you, that you will have something that is going to be in the money. But how much are you risking on this whole trade? On this whole trade, initially, we're only risking 41 cents. But if it works out, can we make more than that? Yes. Now, this unit right here that I said to you, that's the unit that you might be hating yourself. And why are you hating yourself with? Because what you paid 260 is now worth what? $1.87. What does that mean? Well, let me now show you. Refresh the page. How do you feel now? Market is going down. So it wasn't a scenario that I was talking to you about and taking pictures here and showing to you. It's going to go up. No, my gut feeling was down. So I can now hesitate or I can go ahead and fire the trade in. As long as, ladies and gentlemen, I go ahead and sell this for anything greater than a 303, I should be fine. 303, 303, 303. Where is it right now? Now it's at what? 231. So am I already at loss? Well, think about it. What's the worst possible thing that is going to happen? That I'm going to be having a winner of the bear call, and on this long call, I'm a loser. Is that a possibility? Yes. Here's another revolutionary thing. Who said that you must sell 364? Could you sell the lower one? Could you sell lower one? Can you sell the 363? Yes, but then you're putting what? More money at what? At risk. Could that happen? So I like the question that I got here. So what would be the target to exit, both up and down? This is exactly, Mark, what I'm trying to present to you. This is exactly what I'm trying to present to you. Right now we're dropping. We went as high as, what is that? 369.38, and now we're at 365. Right now, all of these units are still in the money. All of these units are still in the money. If the price goes below the 364, I made my 61 cents on the, 59 cents on a bear call spread, right? So how do I know I got 59 cents? I got filled in the 59 cents. Can I subtract that 59 cents from the 260 and make sure that as long as my 260 is still somewhat above $2, I'm breaking even on it? Could that be a possibility too? Take a moment to type the answer here, because a lot of these questions that I'm asking, I know the answer, but I want you to think about it. Think about it. Anybody? Take a moment to type in the answer. This still could turn around and go even higher. There's a higher chance now that we may actually go higher than lower, because what I'm observing here, and I'm going to just point out to you, if you are now looking here objectively, and that's the biggest thing to do in any combat, what kind of jobs bears are doing at pushing this lower? Good job or a poor job? Yes, poor job. Excellent question. Poor job. Because if these are strong buyers, would we get a size of the bar as this right here. Let me do this better with the circle. With the circle, would we get the size of the bar like this if the bears are not strong? Think about it. This one bar has negated about the three or four of these. So right now, I still don't need to do anything. I know the session is going to end in a few moments here, but I want to point out to you again, in this case, be aware of it only when the edges, either the top or the bottom, are taking out. Then you need to do something. As of now, there's no activity. And again, it's a bad thing that we have this session during the lunch hour. So if we go up, we're going to switch a bear call into a bull call, which was this scenario 3 that I actually wanted to explain to you. And what do you mean by that? Well, think about it. Our position is that we bought long 2 of the 365 calls. And if price rips, and let's say it's at the 367 and it's going higher, okay? What is the one thing that we need to do? We need to then exit the 364 and perhaps buy something that still has a value. Buy still something that has a value. So because I need to end this session, I'm going to flip this to the bullish right now. Just for you to learn this lesson. Again, before I do that, I want to revisit the activity on a particular option. And reason why I'm saying that, because we started by inserting into the SPY the open interest volume map. So we're adding here option volume map. I'm not going to be changing anything because this is already set up in such a way that it's going to show me the monthly. So I'm going to be now adding the monthly. And the reason why I'm doing this, because I'm debating whether I should do 367 or 366 in terms of the strike prices for selling. And I'm using this because right now they can't cheat me. These are the open contracts that are going to die today. And I want to see in the terms of the activity. And of course, SPY has even 50 cents increment, but I don't want to get into that right now. I want to just observe over here. What is this activity right here? There's a lot of contracts traded right here at the 367. So I would have an ability right now to close my 364 and to place the 367, giving myself another possibility. And we're dancing here around the 366, whatever, 365 and 93 and whatever, and that changes. So I'm going to do this, and I'm going to try to close the session by asking Q&A, and then we need to wrap it up, right? So what am I doing now? I'm actually buying to close this. Okay, wait, let's bring the 367. And look how rich the 367 is. So 367 is actually the one that I'm selling, and I'm buying this one. So 245 and 105. Okay, so I'm going to be doing almost going to appear like a bull call spread. So I'm buying vertical, right? So this is not sincere buying. This 364 is actually closing me, but the 367 is what? Opening the new position. That's only $1.50. Send it in. Okay, now I'm completely bullish. Now I did this with the assumption that we're going to go higher, because when I prepared this lesson, I said, okay, I'm going to introduce them to the 3 scenarios: bearish scenarios, neutral scenario, and a bullish scenario. Now be aware of it right now. My delta is no longer neutral. My delta is what? Bullish delta. And what do I have? I still have a 365 call, correct? I still have a 365 call. And then right above it, I didn't trade the 366. I actually ended up trading what? 367. So you're like, okay, but now what do you have? I still have a two calls, correct? I still have a two calls. So I have now sold to open one call of the what? 367, okay? So if you're following this, I'm going to go back over here and just show it to you that my position still has the two long calls that have decayed in value, and this one that I sold for 104, and now it's already dropping at 1. So at this point, can I add one more? Yeah, then I have a two of them. So I can now go and do one more of this. Now, if this is confusing, you don't do it, but I'm saying this right now, 86 cents is going to offset some of my costs of the other one. So I'm selling it in, done. So now I have a balanced bull call spread that at this point in time acts as out of the money. So I have a 2 and 2. So one more time, do you understand now why I disclaim at the beginning? This is for educational purposes only. Please do not take this trade live. We are trading in the paper money, but we are teaching you trading options with options, because when you have an option, do you have a possibility to do these trades? Start bearish with a negative delta, adjust as the market is doing to the neutral delta. And if the market really does this, okay, then close your losers, okay, turn them into a bull call spread. So now we have a bull call spread that involves a 367 sold. If we now rally up to 365.7, that is going to be then $2 in the money, $2 in the money times 2. That's a $400. Within that $400, we have already did the calculation. A lot of these other things that we did are completely negated. So I would highly suggest, would I personally do this on XPF cash? Always, because I don't like on a SPY when they get involved on my behalf, meaning the brokers, in 1 or 2 minutes before the bell, they start closing my position. And if I don't have a, let's say in this paper account, like if I'm not mistaken, there's only $3,000, I kind of purposely started that with less. They would say, oh, you don't have enough cash to cover the maintenance or the margin. So they took a liberty to come in and to start closing this. Mark, on S&P cash, they can't do that because everything is settled with cash. Now, what is the disadvantage? Well, then you don't have a $1 spread. You have a $5 spread, then everything costs you $500. So these trades that I place here twice, right, two bull call spread, that would be close to $1,000. Jeff, I know this is very advanced, but what I suggest to you is that you watch this maybe 1 or 2 or even 3 times and be aware of it. Disclaimer was made for that purpose. There's just so much that we can glean from knowing where the activity is on the last day. But be aware of it. What is this bar? It's green. It has reached to the high, it's reached to the bottom, and it's going where? Sideways. Could you force the iron condors on it? Yes, but that's another lesson. That's another week. So one more time, please stay hedged. Watch this, rewatch this. Give me a like. If you like what I taught, feel free to contact me. I provided already the information. And stay hedged. This is very interesting time we're living. So have a good day and bye.